Welcome back to another Pure Portfolios market commentary video, this time for the month of October, which historically is a volatile month. It's also the most volatile month in a presidential election year. This year, it's been somewhat calm, so we're going to do something a little bit different this month, where we're getting into Wall Street forecasting season. A lot of folks are projecting what happens next year, what happens post-election. Of course, we don't make predictions. In our opinion, you should not listen to predictions. Most of them are wrong. However, we can start to frame the potential range of outcomes and talk about the setup and what the next phase of the cycle could look like. So in general, the more specific and the shorter the time horizon for a forecast, the less that you should listen to it. This is much more broad. And of course, we think in probabilities and look at the future opportunity set of investments to make decisions. So we are going to cover market dynamics, concentration of the S&P 500, future returns, and looking at how often the U.S. actually is in a recession. And by the end of this, hopefully, you can kind of get a sense of how we're leaning for the next phase of the cycle. So today is October 29th, and most of you will be getting this on Sunday, November 3rd. So let's get into it. Okay, like we do every month, take a snapshot of the market action. So starting at the bottom, and again, this is October 1st, basically to the end of October. We're going to be missing 1 or 2 trading days. From the bottom up, this is foreign stocks. This is 7 to 10-year U.S. Treasuries, real estate, and emerging markets. So for those 4 asset classes that I just mentioned, those tend to be sensitive to rates. And a funny thing happened, and I wrote a blog about this. Perhaps we can include that in the notes here. But a lot of folks thought the Fed would cut, rates would go down, and bond yields would go down. And actually the opposite happened. The Fed cut, and longer maturity bond yields went up. And a lot of people were confounded by that. Again, check out that blog post that I wrote about it, which explains the difference between where the Fed can influence rates and yields and where they cannot. So we're starting to see these rate-sensitive areas of the market, real estate, bonds, back up a little bit and sell off. There's this thinking that economic data could be a little stronger than the Fed expects and inflation could come back. That could be true. That might not be true. But again, markets are very much forward-looking and trying to anticipate and read the tea leaves based on data today. You can see the S&P, which is orange, up about 1%. Gold continues its run up about 5%. Bitcoin from October 10th or so really has seen a move higher, up about 20% almost since the early part of October. Some folks say this could be a canary in a coal mine for who wins the election. I'm not going to go there, but certainly Bitcoin, there's some folks that say Bitcoin is telling us something as it relates to the election. Okay, this is a very thought-provoking chart. So there's a lot going on here, but it's actually quite simple. So this is several periods of time. You can see the periods of time here, 2018, 2019, 2012 to 2013. And it basically captures which asset classes perform best when inflation is high and then falls within the Fed's preferred range, which is around 2%. So inflation high, falls within the 2% range, which equity asset classes, and I think there's some bonds and commodities in here too. So which asset classes perform best once inflation falls towards the Fed's preferred range. So the higher up the asset class is on this matrix, the better performing it is. And you can see we have several time periods and then the average best performers here aggregated in the right column. So a couple things stick out here. One is the S&P, U.S. large cap are really good places to be when inflation is falling. And in general, equities in general are a really good place to be when inflation is falling. The market doesn't really care so much about rates moving higher, rates moving lower. It very much cares about which way inflation is moving. The other thing is there's some really large crooked numbers for emerging markets here. And you can see it 2006 to 2007, 2003 to 2004. So there's a lot of people that think the next phase of the cycle, emerging markets, value, which you see here, small cap, which you see here, small cap value, could have their day in the sun. They've been out of favor. They're beaten down. They're cheaper. than U.S. large cap stocks. The next phase of the cycle could see some of these out of favor equity asset classes doing well. And you can see when inflation falls, you'll see value, you'll see small cap. Here's again, small cap growth, core and value, and emerging markets doing quite well. And you have real estate as well. So, I'm going to talk about this a lot. I'm going to write a future post about this, but never in my career have I seen a more cult-like following for the S&P 500 where savvy investors, folks that are retired, folks that are about to retire, want to sell everything and just plow it into the S&P 500. And as we'll see, history is often not kind to that type of behavior. I'm big on sentiment, and when people are crowding into certain areas of the market and crowding into a certain trade, that's when I often pause and think the next phase of the cycle could look different, but more on that later. Okay, there's been a lot of recession calls over the past couple of years, and it's been a rough go for those that are pounding the table and predicting a recession. Let's actually quantify how often the U.S. economy is in a recession, and it's less than you might think. So basically what this is, it's a matrix of the frequency, the number of observations by quarter the U.S. is in a recession. So on average, since 1950, the U.S. averages 5 quarters of recession during a 10-year period. Okay, so an easy way of thinking about that is 1 year out of 10 for any given decade, the U.S. is in a recession. Some periods we get more, like 1973 to 1982. We got about double that, so that would be 2 out of 10 years that we were in a recession. Some years, or some periods, we get less. So from 2014 to 2024, we had only 2 quarters, a half of 1 year for that decade that we were in a recession. So the takeaway is the U.S. economy, as it grows and matures, is in a recession a lot less than one might think. Now, I know pessimism sells. It's sexy to hear that the world's going to hell in a handbasket. But when you look at the evidence, the recession frequency is a lot less than most people think. And this came from Goldman Sachs, and what they're predicting, and again, I don't really listen to predictions, but I find this interesting, is to basically be in line with the average since 1950. So over the next 10 years, they're saying the U.S. will be in a recession roughly 10% of the time. But take that with a grain of salt. I find the past 70 plus years much more interesting about the frequency that the U.S. is actually in a recession. This might be my favorite graph of this month. A lot of talk about the concentration of the U.S. stock market, where a handful of companies, call it 7 to 10 companies, have gotten so big, they're really driving the movement of the S&P 500. So I wrote about this a lot too. And being concentrated for any index, and in this case, we're talking about the S&P, is not uncommon. The names at the top of the corporate mountain change, but going back pretty much every decade, there is some sort of concentration at the top of the S&P 500 or the Dow Jones. What's unique about today is the sheer size of market concentration has gotten bigger. It's at the top decile, the top 10% of any period since 1930, and you can see that here. So as we move to the right in this first graph, the more concentrated the S&P 500 is, and you can see this is where we're currently at, in the top 10% of all readings, okay? So what this is measuring, given that we're concentrated now, that at any point since 1930, how volatile are markets going forward from this level? And you can see the more concentration that we get over here on this vertical axis, the more volatile markets are. So as we move up the vertical axis, the more volatile markets are for this concentrated reading here. So that's something to keep in mind. And this is 1 year forward, realized volatility given the current level of concentration. Okay, so going forward, based on where we're at, markets could be a little more volatile due to that concentration in 7 to 10 of the biggest companies in the U.S. Now, looking at S&P market concentration versus 10-year forward returns, these are annualized returns, all right? And again, the bottom axis, as we move to the right, that's the more concentrated the S&P is. Vertical axis is 10-year forward annualized returns given the level of concentration. So again, we're very concentrated. Given the level of concentration, forward returns historically are lower. So not only are future returns going to be lower or potentially lower based on this data since 1930, given the concentration, future volatility could be higher. So higher volatility, lower future returns. And I'm bringing this up because, again, I'm getting a lot of comments. Hey, why don't we own more of the S&P 500? Should I sell everything and just own the S&P 500? I've never seen anything like this in my 20-year career. The data, again, is not favorable to that type of behavior. Continuing on the same theme, this is a distribution of S&P 500 annualized 10-year returns since 1930. This is a forecast from Goldman Sachs, so take it with a grain of salt, but this is in the same vein of what I've been talking about. Again, there's a lot going on here. It's not all that complex when you drill down. So the average 10-year returns for the S&P 500 since 1930 is about 11%. Okay, so annualized returns are at this bottom axis. The frequency of rolling 10-year periods are on the vertical axis. Okay, so how this reads is roughly 5% of the time in any 10-year period, the S&P is going to return about 11%. Most times it's going to do a little bit less or a little bit better. Rarely hits the average. Okay, over the past decade, from 2014 to 2024, which I call the golden decade, the S&P did about 13% a year for that 10-year period. That's actual. Okay, what Goldman is saying, based on where we're currently at from a valuation standpoint, U.S. large cap stocks are historically rich. We saw the more concentrated we are, the lower potential future returns are. Goldman Sachs is saying for the next 10-year period, S&P returns are going to be much lower, about 3% a year going forward for the next 10-year period. Again, you can see that can rarely be the case, but when it is the case, valuations are stretched, concentrations might creep up, and that's where we're currently at now. Okay, this is from Vanguard. So we just heard from Goldman Sachs. What is Vanguard saying? So what Vanguard does is they publish forecast for every equity asset class and style over the next 10 years. So the actual figures for these equity benchmarks is in blue. So this is what they've actually done, annualized over the past 10 years in blue. So we've got the Russell 1000 growth, so growth stocks, S&P 500, small cap, large value, real estate, international, emerging markets, and bonds. Blue are what these asset classes have done annualized over the past 10 years. Vanguard has their next 10-year forecast in red. And you can see, again, in the same vein as Goldman Sachs, they're saying what's worked is probably not going to work over the next 10 years. So that's large cap growth. Small cap should do a little less well. Large cap value should do a little less well. It starts to flip at international, emerging markets, and bonds. This has been a historically terrible period for all three of these asset classes. Foreign stocks, emerging markets, especially relative to U.S. large caps, right? 6.2 annualized, 4.4 for emerging markets, much lower than U.S. large cap. Bonds saw the worst 3-year period from 2021 to 2023, 2024. Future returns for bonds closely track starting yields. Starting yields are higher. It should be a better environment for bonds. So a lot of savvy investors are starting to unwind what's really worked and placing bets on what hasn't worked. So that wraps up our comments for October. This is a little bit different because we're getting into forecasting season. So I hope you enjoyed this. I hope you found this interesting. If there's any other topics that you'd like us to cover next month, feel free to shoot us a note at insight@pureportfolios.com. If you're on YouTube, give us a like. Thanks for watching. We'll see you next month.